Well, hi folks, this is T. Brian Hayes here from Hayes Advisory Group with our March 2015 Educational, Economic, and Market Update. In this month's video, we'll talk about some of the major economic events that occurred last month and give you some insight into what they might mean for you as an investor. As always, please stay tuned at the end for a required disclosure statement. The Federal Reserve and interest rates dominated economic headlines last month. To support the economy, the Fed has kept interest rates at historically low levels since 2008. Since bond buying operations ended last October, the next step will be to start slowly raising interest rates to quote-unquote normal levels to prevent inflation from getting out of hand. After the March Open Market Committee, Federal Chair Janet Yellen announced that the Fed is moving away from a patient interest rate policy and will start thinking about raising rates this year. Though we don't have a date yet, many analysts think that hikes could come probably as early as mid-June. Though investors are getting nervous about higher interest rates, we know that the Fed will move carefully to avoid damaging the economy. Speaking of the economy, we also got a look at the final fourth quarter gross domestic product reading, which showed that the economy cooled a little bit in the last 3 months of 2014, growing just 2.2%. This brings overall 2014 economic growth to 2.4%, up from 2.2% in 2013. Investors care about GDP because it's our most comprehensive economic scorecard and shows us at a glance how the economy is doing. Though the relationship isn't simple, healthy economic growth generally translates into strong corporate profits. All else being equal, strong profits usually boost markets. Digging deeper into the data, we see that strong consumer spending, exports, and business investment supported the economy. The growth rate decreased because of higher imports and lower federal government spending. To translate this all into plain English for you, the economy was fundamentally on very stable footing at the end of the year. Though we don't have first quarter GDP numbers quite yet, clearly the Fed feels comfortable enough about the economy to think about taking away the training wheel, so to speak, and maybe start raising interest rates a little bit. Looking ahead, as the first quarter ends, investors will turn their attention to corporate earnings reports to find out how U.S. companies performed. Right now, overall expectations are lower because of weak overseas demand, low oil prices, and the cold winter. Since leadership teams like to underpromise and overdeliver, we can hope for some positive earnings surprises. We'll know more in the coming weeks. So that's it for the March Educational Economic Update. Now let's take a quick look at the investment markets for March. According to the Canterbury Portfolio Thermostat data, we remained in market states 1 and 2 throughout March, and the volatility index remained below 75, meaning that we still remain in a low volatile bull market environment. Even though the markets keep bouncing back and forth between a couple high and low numbers, we still are in a low risk environment. Realistically, I think the markets did about 0.5% for the quarter. However, this can change at any time, and if overall market conditions do change, we'll certainly reach out to you and let you know right away. But for now, we still remain in a low volatile bull market. As always, if you have any questions or concerns about what we've discussed here, please give our office a call at the number below. Also, to sign up for one of our educational Social Security workshops or IRA Trust workshops that we're now doing, please simply call our office for dates and times. Once again, it's T. Brian Hayes here from Hayes Advisory Group, signing off for the month of March 2015. Please remember, nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 1-800-939-1603 or 765-452-PLAN. We'd be more than happy to talk to you. We'll talk to you next month.